Hans Goetti, Chief Investment Officer with Asia Finaport Singapore, joins us live via the Skype link. Hans, good morning and fantastic to have you back. Hans, for emerging markets, the core concerns are not over, which is growth and earnings. But surely emerging markets have come a long way from the recent low and they've managed to climb the wall of worry.
Well, that is correct. And of course, the weakness started really when the tapering talk took place in May by Mr. Bernanke. And of course, as we know, tapering is pretty much off the table for this year. And it probably remains a 2014 story, if anything. And we have seen a 90% correlation between the Fed's balance sheet and equity prices in the U.S. And of course, that spills over into emerging markets as well. So I think for now, the trend remains up because we don't see any tapering on the horizon, at least not for this year.
Hans, hi, morning. Like you're just saying, it seems like tapering definitely has been pushed back to the next year. Emerging markets have been, have had their going pretty well for themselves, including markets like India. Whenever tapering is to kick in, do you think this rally that emerging markets have been witnessing is going to ease out, though?
Exactly. Again, you can look at anything. You can look at earnings. You can look at valuations. You can look at GDP growth or whatever. The fact remains that markets have been liquidity driven for the past few years. And all you need to know is what the central banks of the world are up to, notably the Federal Reserve. And, with tapering probably not taking place before maybe March next year, we think that the liquidity-driven bull market will continue. It's actually quite amazing to see that emerging markets have bounced back so strongly. And if you look at the U.S. market, you see how little it had actually corrected, and it's still up almost 20% this year. So I think that it was probably going to continue despite what everybody else talks about deteriorating or slow fundamentals.
And so do you think globally a lot of complacency has kicked in and eventually we will get a bad headline or some kind of a poor economic headline which will hit us hard and then that will lead to some reversal?
Well, that is always the risk. Again, as long as central banks are on this expansionary mode, we think that the chances for a setback in equities is relatively small. But you're absolutely right. Complacency is running high. Volatility is low. And the economies are not doing that well. Yes, we do have a recovery in the United States, but we're talking about 1.5% to 2% growth, which is one of the weakest, if not the weakest, recovery in the post-World War II period. And in Europe, you see an improvement here and there as well, even in peripheral Europe. So things are improving. Japan is improving. But again, we're not talking about roaring growth that would, support higher equity prices, except for the liquidity creation by central banks. We see very little to support equity prices at these levels.
Hans, what's the sense that you're getting about India in particular? Because we've had a good amount of liquidity-driven rally. The currency as well has stabilized because that indeed, was a key worry for Indian equities as well. What's the call now for the next 3 to 6 months, given the global as well as domestic parameters?
Well, given the fundamentals in India, you would not expect the index to be where it is now. But again, it's a liquidity-driven rally, a bull market that clearly climbs a wall of worry. And we think that the rupee has now rebounded strongly. Maybe there's going to be a bit of a pullback there, but the worst might well be over, at least for now, unless you see a change in the interest rate environment. Let's say in the United States, for instance, that long-term rates are starting to rise in earnest, which again we don't really see for the next 4 to 5 months, as long as the Fed is on an expansionary course. So India, like any other emerging markets, the trend for now remains on the upside.
Hans, so what should investors do? One side you've got fundamental concerns which are mounting on a daily basis, and on the other hand you've got brute force of global liquidity. Those who've participated in last 3 months and last 2 months and last 1 month, they've made money. And those who've worried about economic fundamentals, growth, earnings, they've not participated and they're feeling left out.
Look, it's very simple. I mean, just watch what the central banks are doing. Not what they're saying, but what they're doing. We have a Fed that is expanding its balance sheet by 85 billion a month. And in fact, the increase in the Fed's balance sheet over the past 12 months has equaled that in 2009 to 2010. And you could argue that the Fed is actually pursuing a policy which would be geared towards fighting a deep recession, but the economy is not in recession. Again, we have growth, it's weak growth, but it's not a recession, the economy is growing. So monetary policy is far too easy, and that benefits asset prices. Equities, of course, among the prime beneficiaries.
And so just getting back to India, I mean, given the current levels, both for equity markets as well as currency, would you as an investor put in fresh money into equities at this juncture, or would you wait for lower levels?
Well, again, if you have a short, let's say, time horizon of about 3 months, I think one could probably play a rally that will take place into year-end. We'll see what happens next year in terms of Fed policy and other central banks. But I think for now, between now and year-end, we should see a relatively benign environment for equity markets, and that, of course, would include India as well.
Hans, appreciate your time, and thank you for your take on emerging markets and especially India.